Hey guys, Jeff Caprellian with Capco Futures. Welcome to another edition of the Market Pulse. This is unfortunately my third time trying to record this today. I am having a real Bill O'Reilly inside edition. F it, we'll do it live type moment. So I am sorry if I blast through anything here. If I do, shoot me a message, Jeff at capcofutures.com, and I will offer a more in-depth explanation. Camera issues the first time, audio the second. But we're going to keep going here. We're going to press on and give this to you because it's important information. I want to make sure that you have it. Before we begin, of course, always remember that trading futures and options on futures involves a substantial risk of loss and is not suitable for all investors or producers. Past performance isn't necessarily indicative of future results. So let's get into the smart matrix here. And we're going to look at this in a new light, right? We've fully automated these hedge target numbers. Before we had a little bit of manual override on them. The system has been performing better than the overrides. I'll freely admit that to you. And so you look at this not only as a percentage to use as a guide, but as a measure of are we risk on or risk off right now. So with corn, for example, 90% hedged, effectively with that producer hedge target, that's a risk off sort of thing, right? The market was moving lower, so we want to be risk off. If you get over to something, where we're look at August live cattle, right? 40%, that's kind of mid range, right? Anything that, let's call it 40 or below, 30, 40 or below, we're going to be risk on. 60, 70 or above, we're going to be risk off. Anywhere in the middle, kind of risk neutral. So what do we have here? Of course, we're going to go into all these factors in more depth. I want to look right now, where do we have high feature correlation? Because that's what we're going to focus on. And then where we have low feature correlation, we're not going to pay as much attention to it. With money flow with corn, 26%, with seasonality in feeder cattle, 31%. Those aren't going to be as important as, the algorithm with corn at 74% or 89% with soybeans, um, or, 85% with live cattle. But you look at this and you say, okay, do we have red or green, right? With corn, we have all red across the board, a little bit mixed on soybeans, but still mostly risk off. Fat cattle, mixed. Feeders, right on the cusp here, because trend, we build that into the targets, right? Because that's the number one way we respect the market is by quantifying what is the trend. Is it going up, down? How strong is it? Right now we're weak. It's a pretty weak trend, but uh, some of it's up, some of it's down, and we'll see what tomorrow brings us with that. Right now, that the zones that we're in for pretty much every market is going to be zone 2 or zone 3. That's going to call for callers. But if you're in something where we have low volatility, as we do right now in a lot of markets, and you're comfortable paying the premium and not having margin calls, just using puts or calls, that's going to be the way to go. So let's move into seasonality. This is probably the most interesting one for me. With the 10-year pattern on corn, the normal seasonal pattern that we all have paid attention to forever and ever, we have a minus 40% correlation. So it's garbage, right? We don't want to use anything that has a low correlation, let alone a negative correlation. So we build these analogs, right? We say, what are the most highly correlated years? And then we build a composite that gives us a weighted average of the three most highly correlated years. So in the case here, 2010, number one year at a 50% correlation. That's this dotted black line on the chart. What that also was, it was a rally that happened on the end of June report, June 30th quarterly stocks and acreage report. It was also a year where we had a La Nina to El Nino phase transition around the same time that we're going to have one now. So this year so far has not been, perfect by any stretch of the imagination. Too wet in the western corn belt, central Illinois hot and dry. We're off to the warmest start of the year ever in history globally. So this is not a year without risks. When we have weather patterns like that, that's when we tend to get those late year rallies, or at least second half rallies. After 2010, our second most highly correlated year is 2002. It's a 46% correlation. Both of those years were higher in the second half. And then 2009 was kind of flat, made an early September low, and then rallied from there. Soybeans, really good correlation to 2001 at 56%. You can see that 10-year pattern, minus 68% correlation. So we're not paying any attention to it. 2001 had a big rally this time of year and basically kept that strength up through the middle of July, over like that, and then sold off into the end of the year. 99 traded a little bit lower and then rallied into the beginning of September. 2006 pretty well flat to lower, but then did kind of give us a harvest low and rallied towards the end of the year. Live cattle, 58% correlation to 2014. That's this line up here. Second most highly correlated year, 99, also a bullish year from here on out. And then 2001, that's the outlier. That's our third most highly correlated year, 39%, not terribly strong. That absolutely sank like a stone into the end of the year. So 2 out of 3 ain't bad, right? That's where we put these together. We weigh them based on those correlations, and we get this red and black dotted line that kind of gives us a potential price path. These numbers will change as we move on, right? The correlations will change. New years might come on. These years might drop off. And then we just kind of take it one day at a time with this, but it at least gives us, a roadmap for what could happen, right? We look at marketing as a series of templates that we've developed kind of through experience over the years, right? And we say, okay, well, this has happened, therefore this tends to happen next. And as you go through these and you see enough years, and whether they were years that you saw yourself or were years that you studied in history, right? Like, hey, I wasn't marketing corn in 1958, right? My dad wasn't around in 1958 either, for that matter. So we look at these things both through the lens of history and through the lens of experience. And then with that, we're able to kind of build this playbook library of what could happen. If X happens, then we do Y, so on and so forth. So feeder cattle, 47% correlation to 2012. Low, super low correlations, right? 2007, only 24%, 99, 22%. Kind of throwing this one out. At this point, these correlations have dropped off enough. It's been a goofy year in feeders between the big rally, the big decline, and then all the choppiness. It's really tough. There's nothing that's really like that. So not every year is going to follow a seasonal pattern, whether it's seasonal, whether it's counter seasonal, whether, it's just kind of a random one. And that happens, and that's okay. Moving over to money flow. In corn, pretty interesting. We have week-long liquidation. Last week we had strong short covering. When's the last time we had that? Back here. Week-long liquidation, strong short covering. Guess what happened? The market rallied. So something that we're paying attention to. Soybeans, last week was strong new selling. I believe we had week-long liquidation, strong new selling, weak new selling. So a lot of selling followed by week-long liquidation. What happens next is the question. I think that what we all want to see right now is the market rally. Therefore, what we want to see is short covering. We had a lot of new short building coming in here over the last month. Now, if we want to see that go away, right, or at least the price erase what it's done, we want to see short covering. Today's price action is certainly indicative of that. Live cattle money flow, we had weak new selling after new buying. Last time we had that was right here, strong new buying, weak new selling, market bumped a little bit higher afterwards and gave us this nice rally that we've had in this channel. So we'll get to we just went over the seasonal. Sorry, like I said, this is my third time going through this. So I can't remember the order. We saw that with the seasonals, right? Where we have 2 of those 3 years giving us a late year rally. Or I should say a sustained rally through the end of the year, rather. The money flow is supportive of that. So the seasonality is supportive of that. The money flow is supportive of that as well. Feeder cattle money flow, it's been a lot of kind of nothing, very sideways type stuff. So we'll blast through this one here, move on to the algorithm. What we want to see on the algorithm, or at least what helps us kind of get a leg up on where this thing could go next, is these V shapes that we tend to get. Because the algorithm is based on these bars here, these bars above 0 or below 0. And those are based on another set of numbers. But that's effectively what gives us buy or sell signals, is this going from green to red. And you can see that here. This is a chart of price with, green being long, red being short. We're only a couple of days into a sell signal here, but the sell side of it continues to strengthen. Soybeans, different story, right? We've been in the sell signal for a while, and these bars keep getting closer and closer to 0. If they cross above zero, that puts the algorithm in a buy. It's meant to be long or short all the time. It's not a trading system, right? It's kind of a go, no go, risk on, risk off sort of thing. So, if it puts us into the green here, that's going to be a go. Live cattle, really kind of directionless here on the algorithm. It's not doing a whole lot of anything. Same thing with feeders, right? We like to see these bars basically get beyond one or -1 to consider it strong. Once we get to 2 or -2, we know that it's starting to get stretched. So it's pretty insignificant right now. We'll move into the volatility. This is the implied volatility rank. So where is volatility relative to where it's been? What we have is low volatility across the board. Feeders, extremely low volatility right now. So generally, this is where I said earlier, right? If you just want to be a buyer of options, it's a great time to do that. The problem with that is volatility seasonally tends to fall for the next couple of months. Here's an example with corn, right, where this average volatility tends to fall. Now we've come down so far; it's very possible that we get a rebound. So that's a great opportunity in corn to just be a straight buyer of options, because as volatility grows, if it does, if we get that rebound, that balloon that makes up the price of options will inflate, holding all else equal. Now, if we had high volatility and seasonally it tends to go down, like we do like we normally do, I should say, around now, we would be looking at things where we're just straight short volatility, right? We're looking at selling options, selling spreads, doing things like that. It's a great time to do that. That just didn't shake out here in the corn market, at least for us this year. Soybeans were within the range of volatility for this time of year, tends to decline still. So on things like corn, soybeans, and live cattle, certainly not feeders, but corn, soybeans, this is an opportunity where you can come in and do something like a collar, right? Because you're going to have falling volatility, right? We have low volatility, so that initial put purchase, for example, is relatively inexpensive. But volatility tends to fall, so that means that premium is going to wither away a lot faster than it ordinarily would. Certainly if it were going to increase. So you can come in and do something like a collar or a put spread where you're taking advantage of one leg that is going to be uh, increasing in value, or working for you, maybe I should say, right? Where you have that decline in volatility working for you, whereas on the long leg of it, you have it working against you. So it helps even that out a little. Live cattle, feeder cattle volatility, very sideways. Usually from here on out, we get that big spike up in the early spring, and then we tend to flatline for the rest of the year. Now, I'm going to move over to some charts, and we'll take a look at, what do I have? December corn is up first. We had a nice rebound here off the lows. Um, Basically came in, tested the low that we made in February. This is where we get into that price pattern that I was talking about with the money flow here, where we moved higher. The stochastic is oversold, turning higher on the daily chart. Down here on the bottom right on the weekly chart, same thing. Here's some lines that I just roughed in on take 2 out of 3. But I often talk about the old highs in a market becoming the new lows, and this is a monthly chart of corn. This is a really good way to look at it, right? The more you zoom out, the more perspective you get on a market, on where we are in history. Of course, we all remember corn, sub $3, but if you look at this and you say, okay, well, what was the range that we had in the late 90s through, mid aughts? It was basically $2 to $3. When we got out of that period, we had a couple of years of volatility, and this is how this tends to go, right? You trade through this sideways period in commodities. Corn is the best example of this of any commodity, but you go through this sideways period, something happens, 2008 financial crisis, 2020 COVID, then inflation and all this stuff. You have this range, something happens, the market goes haywire for a couple of years. It tries to figure itself out. It's that rebellious teenager. And then you settle into a new range for a period of time, 5, 6, 7 years. The low that you make on that new period tends to match the highs from the period prior to that. So before that freak out, right? These lows match up with these highs from the early 2000s. So what happens next, right? We have a recipe for this. We had our freak out. We had our COVID and inflation and everything else. And where are we settling into? We're settling into an area right now, and this is front month corn, which is why you see 429 here, where this is matching the old highs. And you see, obviously, we came down, we had a spike into it, but then we stabilized and we failed to break into it again. That's not saying we can't. Nothing here is a sure thing. Nothing in futures trading is a sure thing. But again, we have these playbooks and these templates that we look at. So if we say the old highs tend to become the new lows, we're effectively right at those new lows right now. We're not and it's early in the year to look at this from a fundamental perspective and say stocks are tight, but we're in a place where they're not totally comfortable yet. So that tends to at least be supportive of the market for the time being. Certainly being at the insurance base price, is another tick in that box. I'll flip over to soybeans here. We have the stochastic crossing higher, really good price action off the lows today. Like I said, this is indicative of short covering in the market. Back down into support on a weekly chart. It looks like we could at least get a run up to about 1150 here. See how it reacts there. The wheat market down into a zone of support. There is hardly anything that'll ever get me to say, I like wheat from the buy side. But we have a lot of ingredients here that can kind of give it to us. Certainly, look at how many down days in a row we had, plus a few little up days mixed in. You've got to let the market confirm that, right? Don't try to catch a falling knife or pick your bottom here. Live cattle, we've had this nice trend channel that we've been following here for a while. Trading up towards the upper end of it, we broke out of this triangle pattern on the weekly chart. Those things generally mean higher prices. So I think the question is, does this daily chart get to the top of this, or do we fail here? If we fail before we get to the top of that, that's not a friendly thing, right? That's saying we cannot carry the momentum that we previously had. So the cattle market needs to pick up the torch, run with it to get higher. For that reason, the other factors were still giving us kind of this risk-off, cautious level. Certainly with the market being overbought on both a daily and a weekly basis and on a short-term 30-minute basis, we're liable for reversal at any moment here. Certainly being towards the upper end of this channel, that doesn't it doesn't give you the warm and fuzzies, but overall, longer term, right? You zoom out, things look positive. It's just probably a pullback in store first. Feeder cattle, pretty directionless here. You can kind of make a case for this being a little bit of a trend here, maybe call it a triangle pattern. It's not enough for me to get too excited about anything here. I think it's a really difficult market to read. Certainly our system puts it 50-50 right now, so it sure doesn't have a great read on it either. So, hedge as needed, right? Let's call it ad hoc hedging. If we have risk, if we have margin that we're comfortable covering for you, work through that math with your account manager. We can come up with a plan. We can come up with a plan where we're using, short options to say, okay, well, I'll give it this much room, so on and so forth. So those are the ways to play this. This week, probably not a week of great clarity relative to some of the other videos, right? But we'll tell you when the confidence on things is lower. And I think that this is a week of it. It's a week where we have some good opportunities, right? I hope that we're talking and doing this video next week and the report on Friday gives us some great bullish things. Corn market takes off and we're all sitting here laughing about how panicked everybody got towards the low end of prices way back in 2024. So we'll see what happens next. Friday's the big report. Keep your eyes peeled for that. Be sure you're reading our Smart Matrix commentary every morning, at least for this week, next week, right? We're in the kind of thick of when you want to be paying attention to things. If this were November, December, I get it. You don't want to sit there and read stuff every day. While we're in kind of marketing prime time, pay attention. We do this for your benefit, not for our own. I hate hearing myself talk, especially after doing it now 3 times. So I hope to God this recorded. I don't have to do it again. Thanks for watching. Have a great week.